Thank you for joining us. My name is Michele Levine and I'm the CEO at Roy Morgan. This Future of Retail business address is not a general tour of retail trends. It's designed to make sense of where Australian retail is really heading as we move into FY27. The headline numbers matter, but they don't tell the whole story. Retail is no longer moving as one market. Demand is shifting by customer, category, channel, and geography. For a long time, we've tended to ask broad questions about retail. Is the market up or down? Is the consumer confident? Does the average household have enough money? Now, those questions still matter, but they're no longer enough. The more useful question is where demand has moved, which customers still have capacity, what they want, and which retailers can protect margin rather than slide into commodity pricing. Now it's my great pleasure to introduce Catherine Jolley, our Head of Retail Research and Social and Consumer Trends, to unpick the dramatic changes occurring in the retail ecosystem. I'll be back to wrap up at the end, but for now, over to you, Catherine.
Thanks, Michele. I'm going to unveil the retail story around three big changes. First, demand has become asymmetric. Second, the middle of the market is under real pressure. And third, marketplaces haven't just taken share. They've reset customer expectations around price, range, convenience, friction, and visibility. Together, these three shifts help explain where FY27 growth is likely to come from. Before we get to those changes, it's worth grounding the discussion in the wider economy. Retailers aren't operating in easy conditions. Consumers are cautious. Business confidence pressures continue to shape decisions. But the important point is that pressure doesn't affect all households, categories, or retailers evenly. That's where the story becomes more useful. This is the starting point. The macro environment remains difficult for retail. Interest rates, inflation, weak consumer confidence, and labour market pressure all matter because they change the psychology of spending. Customers don't only spend less, they delay, compare, trade down, and become more selective about what feels worth paying for. So the issue isn't simply lower demand, it's more careful demand. Business confidence is telling us a similar story from the retailer side. Retailers are making decisions in an environment where many businesses expect difficult trading conditions ahead. That affects investment, hiring, inventory, pricing, and risk appetite. When the market is under pressure, business decision-making can become paralysed with caution. The challenge for FY27 is that retailers can't wait for a meaningful recovery, and they certainly can't wait for Amazon's growth to slow. They need to be on top of where demand is still active and where the prize is. The first shift is that demand is now asymmetric. The consumer hasn't stopped spending, but spending is much less evenly distributed. It depends more heavily on category, motivation, household pressure, and mindset. That means the concept of a so-called average consumer has become an outdated planning idea. The more useful lens is where capacity and motivation to spend still exist, right now and where it's shifting tomorrow. This is the core of the first change. Retail is now operating in a two-speed consumer economy. On one side, there are people who still have money to spend but need a strong reason to spend it. And on the other side, there are people under real pressure, looking for ways to control an already tight budget. One side needs a better reason to say yes, the other needs help making the budget work. On the left, the opportunity isn't simply more affluent customers shopping the way they always have. These shoppers may still be spending, but they're choosing more carefully. Premium hasn't disappeared, but it has to earn its place. It needs to deliver confidence, quality, care, identity, or emotional reward. Even financially confident shoppers now want more justification. In a retail sense, the word value has two meanings. On the left of this slide, value is a sense that the purchase offers emotional reward and feels worth the investment. On the right, where we have spending restraint, value means paying less for the necessities of life. These households don't only spend less, they delay. They trade down, split baskets, compare harder, and use promotions to make the week's money stretch. And when people feel squeezed and under pressure, small failures feel bigger. Hidden fees, poor service, missing stock, or a bad experience can push them away faster. They're constantly juggling harder household choices and the mental load of just getting by. This is the next part of the demand split. Price is not a mindset. Price behaviour doesn't define the whole customer. Even a premium shopper can be highly value conscious in one category and very willing to spend in another. That's why affluence or income alone can be really misleading. It tells us something about capacity to spend, but little about motivation, what the category means to them, or their willingness to pay. A deeper understanding of the customer is required. Consumers spend differently in different categories. A customer may reject a small premium in pantry staples because it feels unnecessary, but that same customer could spend heavily on beauty, pets, the grandchildren, sport, technology, or the home, because the purchase provides a personal upgrade or emotional reward. Premium survives where the category carries confidence, aesthetics, quality, taste, or a deep relevance to their desire. The retail implication is pretty practical. At the base, retailers need to protect value because shoppers are comparing harder. But in categories that matter more, they also need to give people a reason to trade up. That is where margin can be protected. The question isn't simply whether a customer is price sensitive. It's who will still pay, where, and importantly, why. This slide shows why averages can be misleading. Growth is real, but it's not evenly distributed. Overall, buyer incidence is flat, but categories and retailers are growing well above the average, while others are going backwards. So the question for retailers isn't just whether the market is growing, it's which consumers in which categories and in what channels. Interestingly, the high growth categories are related to leisure and entertainment, while the negative growth categories are more closely related to needs and nesting. So overall, that picture aligns closely with the two-speed economy. Premium consumers are driving growth, while basic needs consumers are holding back. The second shift is more about market structure. The middle of retail is under pressure because customers increasingly understand the two ends of the market. At one end, premium retailers offer specialisation, experience and identity, while at the other end, value retailers offer scale, price and reliability. The middle is vulnerable, particularly when it can't explain clearly why it should be chosen. This is the barbell argument. Growth is concentrated at the two ends of the market. At one end, premium retailers are winning through specialisation, experience and desire. At the other end, value retailers are winning through price certainty, familiarity, geographic spread and reliability. The middle is under pressure because it often asks customers to pay more without giving them enough reason to do so. This notion that the middle ground is a dangerous place to be is nothing new. It's just right now more pronounced than we have ever seen it. At the premium end, the promise is motivation. Customers need to feel that the retailer gives them a stronger reason to choose. Better advice, better design, better service, stronger identity, or a better experience. That's how premium retailers protect higher margins. The middle gets squeezed when it offers neither price certainty nor a more motivating reason to buy. At the value end, the promise is clarity. Customers know why the price is low, why the range is predictable, and why the retailer can deliver it consistently. That clarity matters when households are watching every dollar. It protects volume, keeps customers coming back, and can defend margin because the model is built for the price point. At the premium end, specialisation does the work. The premium end succeeds when the customer feels more motivated to choose the retailer, not just better served. Mecca and Lululemon do this in different ways. Mecca provides human guidance, curation, and engaging category entry points. Lululemon adds community, identity, and the belief embedded in Chip Wilson's original mantra of cultivating a greatness culture. Paspaley and R.M. Williams show two other premium strengths. Paspaley defends premium through craft, provenance, rarity, and emotional significance. R.M. Williams does it through design elevation, lifestyle, positioning, and a clear sense of contemporary Australian ease. The shared point is that premium has to give customers a reason to pay more, so margin is earned, not assumed. So what makes premium work? Premium retailers need to create a reason for a customer to choose them when cheaper alternatives are quite literally everywhere. That reason might be expert staff, beautifully created ranging, confident pricing in the face of competitor discounting. And loyalty, not as a program, but as a sense of belonging to a like-minded community. The customer needs to feel that the retailer adds something valuable to the decision. And at the value end, the winners are not merely affordable. Scale is the moat. They're engineered to deliver one clear promise consistently. Bunnings and Kmart are different businesses, but both give customers a very clear reason to choose them. Bunnings gives confidence that the job can get done, and Kmart makes low prices feel welcome, rewarding, and low risk. Aldi and Amazon show the same principle in different ways. Aldi turns fewer choices into clearer economics. Amazon turns range, delivery, membership, and zero friction into default behaviour. The common thread is not just price. It's a business model that supports the promise, protects repeat behaviour, and keeps the economics disciplined. This slide explains the mechanics behind what makes value work. The best value retailers don't make low price feel like a warning sign. They make it feel proud, deliberate. Customers feel the retailer has built the business to deliver value, not just cut corners to reach a price. That is very different from discounting, and it matters for trust and margin. That's why the 4 elements matter. Cost is designed into the model from the very beginning. The range is predictable. Delivery is reliable. The promise is repeated and delivered often enough to be trusted. Value retailers protect margin when the whole business is built around the price promise, rather than relying on discounts to drive short-term movement and to train their customers to wait for the next promotional event. This is the warning sign. The undifferentiated middle is exposed when customers can no longer explain why it should be chosen. If a retailer is too expensive to be value and not distinctive enough to be premium, the customer has better options on both sides. The issue is often not poor execution, it's the strategic lack of a clear reason to choose. That matters because the middle can lose margin from both directions. It may discount to defend traffic while still failing to create stronger desire. Or it may try to premiumise without enough service, quality, or experience to justify the price. The danger is ambiguity. Customers don't know what the retailer stands for, so price becomes a very fragile deciding factor. The third change is that retail marketplaces have changed what shoppers expect. This is not just about Amazon, Temu or Shein's unprecedented growth. It's about the standards they've trained customers to expect. A wide range, low prices, fast fulfillment, easy comparison, and less friction. Retailers now compete not only against other stores, but against these new benchmarks. Amazon is no longer just a disruptor. It's part of the establishment. With more than 9 million Australians shopping Amazon over the past year, it has become one of the reference points shoppers use to judge price, range, convenience, and membership value. The practical question for retailers is not simply how to beat Amazon. It's where can they still be the chosen alternative? The risk with Amazon is that it sets the benchmark across several parts of the retail experience all at once. It isn't only price, it's also range, and a range that spans Apple computers at one end of the barbell to ultra-cheap charging cables at the other end. And in addition to price and range, it's membership, search, fulfillment, and low effort. That's why Amazon can become a channel killer. It trains shoppers to expect a standard that many retailers can't match without damaging their own margin. Temu and Shein are doing something different, but just as important. They're scaling fast enough to reset what shoppers think things should cost, even when customers question quality, trust, or ethics. The price benchmark keeps going lower. That has consequences for local retailers because marketplaces are not just taking share of spend, they're repricing expectations. This slide is deliberately uncomfortable. Usage can outrun trust. What does that even mean? Well, Temu can be heavily distrusted and still attract millions of shoppers. That tells us something important. Trust matters, but it's not the only variable in the value equation. Where the perceived price advantage is strong enough, customers may tolerate concerns they would not tolerate elsewhere. That's commercially powerful, but also unstable because it's often short-term. When a brand is so distrusted, it erodes its social license to operate and it becomes a highly fragile brand, fragile to competition, the regulator, and unforeseen risks such as data breaches. So watch this space. This slide is also uncomfortable. Retail has always been and remains one of the most trusted industries. However, we are seeing the early warning signs of growing distrust. Marketplaces create dependence before they create trust. But it's algorithmic dependence. They shape what shoppers see, what gets compared, what appears relevant, and what feels like value. Over time, that can create dependence. They can become useful or even addictive before they become loved. But the same systems that make marketplaces powerful can also create pressure around distrust. Distrust breeders are poor product quality, seller integrity, privacy, and customer frustration. Platforms can come between retailers and shoppers, owning more of the relationship, the data, and the rules. Backlash can follow poor experiences as bombardment, disappointment, and returns can turn convenience into irritation. This is an interesting tension we're watching in the retail sector right now. The next shift is about findability. Findability has moved from shelves to systems. Findability used to be mostly about stores, shelves, and search. Now it's increasingly shaped by feeds, marketplaces, recommendation engines, and AI-assisted choices, the dreaded algorithm. It's not just about SEO, it's also about GEO or generative engine optimization. That changes the job for retailers. The question is no longer the product range. It's whether the product can be found, understood, ranked, and recommended by the new systems shoppers now use. This makes product data a commercial asset. The quality, structure, and completeness of product information can affect visibility. That means merchandising, technology, operations, and marketing all share the responsibility. If the AI agent can't properly understand the product, the shopper may never see it. So this battleground for visibility is a critical challenge for retailers. In short, more of the choice environment is shaped by algorithms and recommendations. In that world, margin can be won or lost before the customer even reaches the retailer's brand. This next section is about what FY27 now demands from retailers. The marketplace story can sound abstract, but the implications are very practical. It changes how retailers should think about delivery, service levels, local operations, pricing, and margin. The retailers getting it right are not simply copying marketplaces. They are deciding which promises are commercially worth making. Delivery is now central to the offer. Delivery is no longer back-end logistics. Customers experience delivery as part of the value proposition. Speed, choice, timing, and control all shape how the retailer is judged. But the danger is treating every order as though it deserves the same promise. Delivery is now both a margin decision and a brand promise. The old model was simpler: one delivery promise, free delivery as a blanket incentive, and operations owning the problem. FY27 needs a more commercial view. Some customers will pay for urgency, some orders can wait. Retailers need delivery promises that customers value and will pay for, helping the business to afford the service. This is the practical implication. Free delivery is not a strategy if it destroys margin. Retailers need a priced service architecture that gives customers real choices: urgent, nominated, consolidated, or slower and free. The point is not to copy marketplace promises blindly. It's to decide which delivery promises make commercial sense. In a nutshell, there are some really critical decisions retailers need to make, and that's where Roy Morgan comes in. And on that note, over to you, Michele.
Thanks, Catherine. Thinking about everything Catherine has just said, everything starts and ends with the customer. And knowing where to find your right customer is commercially important. Growth is not evenly distributed by customer, category, or geography. That's where Roy Morgan Live Mapping helps retailers see where the valuable customers, priority mindsets, and category demand are concentrated, down to local trade areas and even street block level. That's important for store investment, local ranging, media targeting, outdoor placement, catchment marketing, and delivery decisions. The point is simple. FY27 growth is not just about identifying the right customer. It's also about knowing where enough of them live to make the decision pay off. For retailers, that can shape which stores to renovate or upgrade, which catchments to defend, which locations to target, and whether a premium or value model has the best chance of working. The future of retail won't be won simply by category expansion or channel growth. Consumer confidence is likely to remain soft for some time yet. At the same time, competitive pressure will only intensify. Amazon will keep coming, and the pressure this exerts will be like a continued vice-like squeeze on the retail market. And they will keep raising customer expectations on price, convenience, range, and fulfillment with every step. There's no doubt that competing in this market has its challenges. This is where we see our role here at Roy Morgan being very clear. For retailers, FY27 growth won't come from chasing the average consumer. It will come from precision, knowing who still has capacity and propensity or desire, what they value, where demand is resilient, and where market share can still be won. At Roy Morgan, we provide the evidence and the proof to help retailers move with confidence, identifying the customers, regions and opportunities that will drive sustainable growth in a really competitive and cautious consumer environment. So to wrap up, the right strategies require real confidence in decision-making, evidence-based decisions grounded in real consumer insight and market intelligence. Thank you for listening. See you next time.